Good morning, everyone, and thank you for choosing the market briefing analysis of today's financial news. Every day, our goal is to provide you with a thorough and knowledgeable analysis of the most relevant financial news to help you navigate the complex economic landscape. Let's begin our daily review. Financial news, June 9, 2023. U.S. stock futures indicated a pause in the market after the S&P 500's recent rally, while the dollar faced its largest weekly loss in a month. This comes as investors speculate that the Federal Reserve is nearing the end of its hiking cycle. Let's dive into today's top international financial and market news. In pre-market trading, Tesla Incorporated shares surged by 4.5%, poised to extend their winning streak to an impressive 11th consecutive session. The boost in Tesla's stock can be attributed to General Motors Company announcing its collaboration with the company's charging network, leading to a 3.5% rise in GM shares. This partnership demonstrates the growing importance of electric vehicle infrastructure in the automotive industry. Meanwhile, Target Corporation experienced a setback as its shares retreated by 1.3%. Analysts at Citigroup Incorporated downgraded their rating for Target, citing challenges related to slower foot traffic and intensified competition. Despite this downgrade, the retail sector remains dynamic and competitive, and investors are keeping a close eye on the performance of key players in the industry. As we approach next week, market participants are exercising caution, refraining from taking significant positions. The focus is on the upcoming interest rate decisions from both the Federal Reserve and the European Central Bank. Recent unexpected rate hikes from other central banks have fueled speculation that policymakers may need to maintain higher interest rates for an extended period. Additionally, U.S. data indicating a cooling labor market has reinforced the consensus view that the Federal Reserve might adopt a more cautious approach. Before we continue with our analysis, we'd like to remind you of your support for our channel, the Market Briefing analysis of today's financial news. If you're enjoying this video and find our content useful and engaging, please consider giving it a thumbs up and subscribing to our channel. This helps us grow and bring you even more quality content. Now, let's get back to the financial market news and the latest updates. The backdrop of late has been one of heightened macro uncertainty, but with inflation still running uncomfortably high, highlighted ING rate strategists led by Benjamin Schroeder in a note. While they believe the Federal Reserve has already reached its peak policy rate, a higher reading of the Consumer Price Index, CPI, could potentially result in another rate hike next week. Nevertheless, it is anticipated that the Federal Reserve will leave room for potential future adjustments in their monetary policy. Moving on to the bond market, Treasury yields have ticked higher, with the 10-year rate standing at 3.75%. Swaps traders have currently priced in approximately a one-third chance of a Federal Reserve rate hike next week, with the odds of a hike in July reaching almost 90%. These indicators reflect the market's expectations regarding the Federal Reserve's stance on interest rates. While Japanese shares continued their impressive rally, with the Nikkei 225 jumping 2.4% this week, European stocks experienced a retreat. Croda International plc's downbeat outlook weighed on chemical shares, contributing to the European stock market's overall decline. It will be interesting to see how these trends evolve in the coming weeks. In the currency market, the Turkish lira faced further decline, reaching an all-time low against the dollar and experiencing an 11% drop for the week. This decline came as President Recep Tayyip Erdogan appointed a new economic team, signaling a potential shift toward more conventional policies. On the other hand, the Eurozone slipped into a technical recession in the first quarter of the year, with a 0.1% contraction in GDP. However, the United States continues to evade a recession, primarily due to robust consumer spending and a strong labor market. Although the United States remains relatively resilient, recent data reveals signs of a slowdown. The number of new jobless claims for the week ended June 3 surpassed expectations, reaching the highest weekly rate since October 2021. This data aligns with the May jobs report, which showed an increase in the unemployment rate to 3.7%. Despite these developments, investor sentiment remains optimistic, as all three major U.S. stock indexes traded higher on Thursday, with the S&P 500 reaching its highest closing level this year. However, European markets displayed mixed and subdued performance, with the Pan-European Stock 600 closing flat. Shifting focus to global economic trends, we observe a phenomenon called shrinkflation, where companies reduce product sizes while raising prices. In economies, a similar pattern is emerging. The Eurozone recently entered a technical recession in the first quarter, accompanied by an annual headline inflation rate of 6.1% in May. Although this figure is lower than expected and a drop from April's reading, the European Central Bank's president, Christine Lagarde, considers it too high and anticipates the need for additional interest rate hikes, which may bring economic challenges. This trend is evident across the world, as central banks in Canada and Australia surprised economists by raising interest rates this week. Despite slowing economic growth and slumping exports, the Reserve Bank of Australia felt compelled to hike rates due to higher than expected inflation. These examples highlight the significance of next week's Consumer Price Index report for the Federal Reserve. If inflation data comes in hotter than anticipated, it could impact the future trajectory of interest rates. As yesterday's market gains were welcomed, investors must remain cautious about the potential impact of shrinkflation on the U.S. economy. The upcoming Consumer Price Index report will play a vital role in shaping the Federal Reserve's decisions going forward. Stocks S&P 500 futures fell 0.1% as of 7:17 p.m. Tokyo time, while Hang Seng futures rose 0.6%, and S&P/ASX 200 futures rose 0.3%. However, Euro Stoxx 50 futures fell 0.4%, indicating a mixed start for global markets. In the currency market, the Bloomberg Dollar Spot Index remained relatively unchanged. The euro, on the other hand, fell 0.2% to $1.0760, while the Japanese yen experienced a decline of 0.4% to 139.53 per dollar. The offshore yuan also dipped by 0.3% to 7.1430 per dollar. Turning to cryptocurrencies, Bitcoin maintained its stability, showing little change at $26,639.77. However, Ether experienced a slight decline of 0.5% to $1,844. Shifting our focus to the bond market, the yield on 10-year Treasuries saw an increase of 3 basis points, reaching 3.74%. Meanwhile, Australia's 10-year yield declined by 6 basis points, settling at 3.95%. In the commodities market, West Texas Intermediate (WTI) crude oil rose 0.3% to $71.17 a barrel. However, spot gold experienced a slight dip of 0.1%, settling at $1,963.39 an ounce. In conclusion, we'd like to thank you for watching the market briefing analysis of today's financial news. If you enjoyed our insights and found the information helpful, please consider leaving a like and subscribing to our channel to stay updated with future analyses. Thank you again for your support, and we'll see you soon with more fascinating news. Remember, the information in this video is purely informational and does not constitute investment advice. Always consult with a professional before making financial decisions.